I just saw a chart where March deliveries of silver had their second highest ever. If you go back, I'm not sure how far back they track, but the chart that I have goes back to 2007, and it's a clear standout that people are taking physical delivery from the COMEX for their silver and their gold. And this is unlike the Shanghai, for example, futures exchange. This is an exchange that was not set up for physical deliveries. I think it speaks to a little bit of anxiousness. Participants really want to have their hands on the physical silver, are uncomfortable with with futures, and yeah, I mean, again, just to kind of summarize it, I think the draining of these secondary inventories, both where all three, New York, Shanghai, and London, speak to the need for physical to meet demand.
Peter Krauth, a seasoned precious metals analyst and author of The Great Silver Bull, dives deep into the evolving dynamics of the silver and gold markets. In a recent discussion, he pointed out that March saw the second highest physical deliveries of silver from the COMEX since 2007, a clear sign that demand for physical metal is accelerating. Unlike paper-based futures, this is about people wanting the real thing in their hands. Why the shift? Krauth points to industrial needs, short covering by institutions, and fears of future tariffs or delivery shortfalls. As inventories in London plunge to 10-year lows and silver flows to private vaults in New York, it's evident that physical supply is getting tight. He warns that the market is signaling stress. Investors are more willing than ever to pay a premium to secure physical silver. Now, we present the latest clips of Peter Krauth's video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think that the error was not taking deliveries more gradually earlier. That was the error. Waiting and wanting to try and do this all in one shot. I think that what we've seen happening with these huge flows of gold and silver from London to New York are very indicative of. Some of it. So there's a couple of arguments. One of the big ones is the obvious one that there was concern about tariffs on these metals. So if someone had to deliver into a contract before a certain deadline, with tariffs potentially having been added to these metals, that they didn't want to get caught offside and have to deliver metals that they didn't have on hand and have to pay this, whatever it might have been, say 20 or 25%. That would obviously sink a bunch of institutions. There's probably three things happening. There's probably some of these are participants that want to have the physical metal to offset some shorts. I think that you've got some industrial consumers that want to get the physical in their hands because they need it for a production of all kinds of things, anything from solar panels and EVs all the way to military applications. And then you've got a lot of these deliveries. What I've heard is that you know not all of these deliveries are going in and staying in the COMEX. They're actually the metal is flowing to New York, and then it's going into private vaults in the New York area. So, I mean, there's obviously very little information around that, but these are the kinds of things that I'm hearing. And if you look at the London inventories, I've got a chart in front of me, and I mean, it's at 10-year lows, and it's dropped off. It dropped off dramatically in 2022, and then it's dropped off again dramatically in the first 3 months of this year. So obviously, the last few months, that's because most of that will have flowed to New York, but London is the largest, has the largest inventories, or still has, I think, the largest inventories of silver. So it's starting to get really, really tight in terms of physical supply, and the exchange for physical premiums on silver have been through the roof. So that means that market participants really, really want to get their hands on physical silver, and they're willing to pay for it. So that really, again, speaks to very much clearly speaks to tightness in the market, and I think it speaks to a little bit of anxiousness. participants really want to have their hands on the physical silver, are uncomfortable with with futures. Yeah, I mean, again, just to kind of summarize it, I think the draining of these secondary inventories, both, we're all three, New York, Shanghai, and London, speak to the need for physical to meet demand. I think that the run up that we saw in the last few months was pricing in the concerns, and there was a premium in there. So I think the market bought the rumor and then sold the news when the tariffs came out. We saw that the tariffs clearly did not apply to gold and silver, so that some of that premium has gone away, but not all of it. I'm convinced that. It wasn't a huge premium because you can see now that the metals have not, and gold in particular, has not backed off that much. I think there's some risk of a little bit more downside, especially if you see. I think we're probably due at this point for a bit of a bounce in stocks. I think that I'm not saying they're cheap now. I'm just saying that I think that the sell off was, in fact. It was a bit of a historical sell-off, is what I'm reading in terms of the degree um, over the time frame that it took to get that correction in stock prices. So, very much near term technically, I think stocks are due for a bounce over the next few weeks probably. And if we get that, I could certainly see, funds flowing towards stocks and away from precious metals. I think we could see a second smallish leg down in the precious metals, and I think that would make for an absolute perfect opportunity. It's interesting, you hear all these all these sort of theories and ideas about why Trump's doing what he's doing. And one of them that certainly to me makes some sense is that, if he has, let's say, proper or true intentions of trying to sort of right a ship, and knows that, the US is on an unsustainable debt path and so on. There are huge amounts of I saw that it was something like $9 trillion of US debt coming due this year and a large amount again next year. I mean, the US debt is about 36 trillion. So we're talking about a quarter of US debt coming due this year. Think about how we are at considerably higher rates than we were, a few years ago. So to have to refinance all that debt at now much higher rates leads to even bigger deficits. So I guess the scenario or the narrative was that Trump was doing this to sort of quote unquote, seriously pressure markets to get the economy to weaken considerably as well, which would force the Fed to eventually cut rates, which would make refinancing U.S. debt a lot more palatable at much lower rates. So that's one narrative, which, if you think about, has makes some sense to a fair extent. I just think that this whole thing with precious metals has a long way to still play out. If you ask someone, 15 years ago when gold was at, I don't know, let's say, five, six, $700, if they could see a time where it was going to go to 2000, they thought you were crazy if you said absolutely it's going to 2000. And today we're at 3000. We're 50% above, that kind of level, and yet people are really just only sort of starting to get interested. We've started to see funds really shift and flow into physically backed precious metals ETFs, which it's interesting. If gold can go from 2000 to 3000, and funds will flow out of these ETFs. So it tells you that the appetite was not for the metals, despite there was no chasing in a sense. Really, there was no chasing these metals prices higher. What investors were doing was they were chasing stocks, and so I think we're starting to see a big rotation start to happen, especially now that we've had this huge correction. I think the smart money was getting into precious metals because it saw the extreme overvaluations in stocks, and the smart money was in early. And I think now you're going to start to see that trickle down from smart money, to sort of more sophisticated investors, and then you're going to get moved towards this sort of regular informed investors and down to the dumb money, so to speak. And that's going to take a while to play out, and then you're going to have a lot of fear of missing out, and that's when you're going to get these huge run-ups. Within a few years, we're going to have days where gold is going to be up a couple $100 in a single day, and we're going to see, once you see silver take out, I think right now probably the next major important hurdle for silver is about 35 to 37. That's sort of an important quarterly close. That's going to be a big milestone. After that, the clear next upside milestone is going to be $50. After that, we're in uncharted waters, and I think we're going to see some big gaps upward from $50. You can see 70, 80 matter of days or weeks after that. So, these have forever been safe havens. They're still in many ways, on many metrics, relatively cheap. And so I think that there's a lot of runway left in both metals. People just need to start to have at least some kind of exposure.
Krauth believes we're still early in this long-term precious metal story. Gold is holding strong near record highs, and silver is poised to break key resistance levels. These aren't hype moves, they're foundational shifts. Once silver breaks above $35 to $37, he expects it could rocket past $50 and beyond in days. He stresses that smart money is already rotating into metals. Retail investors, don't sleep on this. The fear of missing out will come fast. Now's the time to get exposure, even just a little. Share your thoughts on Peter Krauth's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.